Let's talk about what the Federal Reserve just stated. You guys have heard my speech for a while now. Federal officials see higher rates for some time ahead. That is not good. And if we had to say, what is this going to lead to? This is going to lead towards the markets dropping on down. Ladies and gentlemen, don't overthink these things. It says the Federal Reserve officials are committed to fighting inflation and are expecting high interest rates to remain in place until more progress is made. According to the minutes released on Wednesday from the central bank's December meeting, at a meeting where policymakers raised their key interest rates another 0.5 percentage point, they expressed the importance of keeping restrictive policy in place while inflation holds unacceptably high. Participants generally observed with that restrictive policy stance would need to be maintained until the incoming data provide the confidence that inflation was on a sustained down path towards 2%. So ladies and gentlemen, we right now are sitting with inflation at 7.1%. We've gone over this. We've talked about this before. I'll even draw out a little visual to make sure every single person understands this. This is all you guys have to understand. This is inflation, okay? It's in blue. Now, last year, inflation rose rampant, and inflation was higher and higher and higher and higher. Now, how high did we get with inflation? We got all the way up to 9.1%. That was how high inflation was. And this was all the way back in June of last year. Throughout this period, what have we done? Well, we've raised rates, and we can put in red that we have raised our rates. And we've raised rates multiple times. We raised rates 0.25%. We raised rates 0.5%. We raised rates 0.75. We raised rates 0.75. We raised rates 0.75. We raised rates 0.75, and we raised rates 0.5% last year. So as we raised rates, guess what happened with inflation? Inflation went from 9.1%. We kept raising rates as months went by, and it did fall. It did start to drop. It did start to get a little bit weaker, and here we are right here. This is where we're currently at. Now, what is this current number? This current number is 7.1%. So if we want to think about this, team, throughout a 12-month span, right? June was when we had our highest point. December was our last meeting right here, right? Where we're at 7.1%. Over again, 12 months. We have done a lot of interest rates, as you guys can tell. We have raised rates on up, and we have been able to decline, right? We've been able to drop inflation about 2%. Now, what is the goal? The goal for the Federal Reserve is to bring it to 2%. So we've dropped inflation 2%, but their overall goal is not to have it at 7.1%. Their overall goal, the Feds want to bring it to, is down to here. This is the Federal Reserve's goal. We have to get inflation down to 2%. Now, ladies and gentlemen, what is the only way to bring inflation down to 2%? What's the only way? Let's keep adding interest rates. 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 As we, of course, raise interest rates, guess what's happening? We are making everything more expensive. If we make everything more expensive, that's going to make you as the consumer right here say, hey, I can't afford anything. That's going to make you sad and upset, and that's going to make you not spend your money. You're not going to spend your money if you are going to have to pay interest on, again, what you're spending. If that's homes, if that's cars, if that's on your credit cards. So you are going to, again, not spend as much. You're not going to be as crazy. And what we want to see is as we make things more expensive and more expensive, more expensive, over time, we get to this 2% interest rates as, of course, everything gets more expensive. Now, that's where we're at. Remember, team, let's think about where we're on our calendar. It is January. It's January right now. And it took us, how long? 12 months to bring down inflation 2%. We do need to think about, we were coming at a very strong area. We had to not only stop inflation, but then, of course, bring it back on down. In 2023, we should be able to accelerate the slowdown of inflation. That is not going to happen most likely after one more interest rate, most likely not after two more interest rates. Most likely that's not going to happen after 3 more interest rates. We are probably not going to be stopping interest rates until somewhere in May or after. That's my prediction at this time. We can see that when we take a look over on, let's say, the markets right here, the markets, the S&P 500, we all know what has happened in 2022. There's nothing that no one knows of right here. When we take a look over on the S&P 500, what can we tell? The S&P 500 has come dropping on down in 2022, and it's actually the worst year we have had since 2008. We know that since 2008, this has been the hardest year on the stock market. Here's 2008 right here with a 38% drop. Here's 2022 right here with a 19.4% drop. The only tough time along this area was 2002 when we had the dot-com bubble. So we've had this monster red candle. And if we say to ourselves, what has led to this monster red candle happening? Well, we've raised interest rates. We're not all of a sudden going to start moving on up just because it's 2023. We need to see something different happen. So if we are going to continue to raise interest rates, as we can see right here, the Federal Reserve, the Fed officials see higher rates for some time ahead. They're not giving us, a projected timeline. They're just saying, hey, we got to keep raising interest rates because we need to bring down inflation down to our 2% path right here. So this is going to continue. And as it continues, we are going to continue to see the market have the same results that it has been having, which means the markets are going to drop. For those who do not know, right? And let's just draw a little bit of a new picture here. We are not going to see a new bull rally until we get to the phase of pausing interest rates and then cutting interest rates. Now, this is not anything that is a prediction. This is not a prediction. This is a fact. We will always see that we are going to be having what? We are going to raise interest rates when inflation comes on up. So let's say we have phase one is just going to be raising interest rates. Raising interest rates, as we know, is going to make everything more expensive. As we make everything more expensive, it's going to lead towards the markets dropping. We are again having a very tight monetary policy. Phase two is where Jerome Powell states, hey, we have raised interest rates enough. We are all good to go. We are now pausing our rates. So we're pausing our rates. We can see that we're basically just moving sideways at this moment. And what we want to be waiting for is going to be phase three. Remember, this is not a prediction. This is a fact. Every time in history that we have cut interest rates, that is when the next bull market has started. So if you are sitting on your hands right now and saying, man, I have $100,000, I got $5,000, I got $1 million, I got $1,000 that I want to invest into the stock market, I'm telling you the answer right now. The best time to invest in Apple, the best time to invest in the S&P 500, the best time to invest in Tesla, the best time to invest in Microsoft, the best time to invest in whatever is when Jerome Powell comes out here and states, hey, we are going to start cutting interest rates. Because when you cut interest rates, that's looser monetary policy, which means everything's more expensive. And essentially the way you can think about it is those printing money machines are turned back on. Right now, we got tight monetary policy. We're going to raise interest rates, make everything more expensive, keep money nice and tight, no extra spending, no again printing out money, no nothing. But then the market is again taking a hit. The economy's taking a hit. We're going to start falling lower and lower and lower and lower. And for the sake of the economy, for the sake of the United States, we need to start stimulating the markets again. So let's pause interest rates. After we pause interest rates, we have to give it a few months. And then we say, let's start cutting interest rates. And that's where we start seeing the market start explode. So right now, traders, what are we at? I would say probably the last few stages of phase one, because the first few stages would be again that 0.25. Then again, we had 0.5. Then we had 4, again 0.75. And then we just went down to 0.5. If I had to make my prediction, I think we're going to have another 0.5 coming on up on January 31st. Then we're going to probably have another 0.5 as we move over into March. And then I think we're going to have another 0.25 as we head into May. And then after May, I think we move to phase two, where Jerome Powell is going to come on out and he's going to say, guys, hey, we're pausing interest rates. We don't need to do it anymore. Inflation is on the trajectory path all the way on down towards 2%. After we get somewhere near 2%, 3% maybe, he's going to say, hey, let's start cutting interest rates. That's where, again, the money machines are back on, and that's where the market's going to spike. So where do I honestly believe the market's going to fall down to? Well, let's just do, again, some simple, easy math, okay? We have fallen from 480, and we have dropped all the way on down towards around the price of 350. So we have fallen about $130 over the past 12 months, and not even the past 12 months, over the past 9 months when we actually hit a low. Heading into 2023, we can see, of course, the brand new article that just came on out that it says right here, we are going to continue to raise rates. The next big thing that's going to drop the market is, I think we may have a couple small green days, we may have a couple small red days, but everyone's going to be aware of this. The next big time that the market's going to turn and drop is going to be when we have CPI data, and that comes on out for the month of December. Who remembers in 2022, last year, what were the 3 biggest reasons on why the markets went on huge dumps? Does anyone remember what happened on this day, on August 26th, when we had this massive dump? Does anyone remember what happened on this day, on October 13, when we had this massive spike? Does anyone remember on this day when we had this huge dump, when we had this huge spike, when we had this massive sell-off? This happened for number one, when Jerome Powell spoke on an open meeting. Sometimes you would have Jerome Powell speaking at Jackson Hole, Wyoming, and he would give his thoughts, and the market would react to his thoughts. We would have number 2, when we had interest rates be raised. Interest rates be raised. We usually have meetings on average about every month and a half where Jerome Powell will speak after, again, raising interest rates. And that also gives us some ideas on where the market's going to be heading. And last but not least, number 3 was CPI data. Whenever CPI data came out, which was once every single month, would show us how inflation is currently doing. So at this time, if we see that the S&P 500 has been falling for the last 12 months, this has been the worst year since, again, 2008. Prior than that, the worst year was 2021. We are now seeing that the Jerome Powell and the Federal Reserves are saying that they are going to continue to do the same exact thing that we are going to be doing in 2022, which has led to this massive drop. We can't expect to see anything different. And you're not going to see anything different until we move to phase 2, which means we are going to pause interest rates. So for anyone that's buying long-term investments right now, it's too early. For anyone that's saying, oh, Deck, I'm going to get involved and hold tight on cryptocurrencies or houses or whatever, it's still too early. I'm telling you right now, if you want to wait for the clear-cut start of the bull rally, it's going to be when we start cutting interest rates. If you want to try to get a little bit early to the train, go ahead and you can try to do that, but wait until Jerome Powell says they're going to pause interest rates. So those are the big things that you want to be waiting for, but why would we want to do a long-term investment, and why do we think the market's going to randomly shoot on up when we're going to be doing the same exact thing as last year? If last year you gained 50 pounds and it was because you ate ice cream and candy bars every single day, and this year you said, man, I want to make a difference, but you still eat candy bars and ice cream every single day, you're going to look exactly the same. Once you say, hey, you know what? No more candy bars, no more ice cream, I'm having fruit and vegetables and working out every single day, you'll see dramatic results. If Jerome Powell says, hey, you know what? We're not going to raise interest rates anymore, we're actually going to do the opposite and cut interest rates, you're going to see the opposite results. And that's what we're looking for. So it's going to take some time, but do I believe the market's fallen? As you guys know by now, yes, it's going to fall. It's not just going to go straight down. You will have your green days within your red days, but overall, I don't think we see any sort of difference until we start again cutting interest rates, or at least go to phase 2, which is going to be pausing, which will be around summertime. So we'll see what's going to be coming on up over the next few months, but make sure you guys are ready for the next CPI data, and also make sure you guys are ready on January 31st and of course February 1st, as that is the next interest rate raise, which most likely is going to be 0.5% once again. All right, make sure you guys are all set there.